Hello and welcome back to this course on financial frauds, understanding how it's done and how do we detect it. The next thing that how the financial frauds are done is timing differences. So what is the timing difference? Timing difference means we are not matching our revenue and expenses into the same period. So you may have a sale in one period but you are recognizing the purchases in the next year, or you are recognizing the related expenses to it, maybe the salary or the other revenue generating expenses, cost of transportation into the other expenses or other period of time. So that is called matching of improper matching of the expenses. So the timing differences are there. It's usually done to improve the profitability of the company or to maintain the profitability of the company. Times you may be in some months you may have overspent the money, or the prices have increased for the material, but you're not able to increase the price of the sales. And in order to improve the profitability, you shift some of your expenses to next year so that you can show a consistent increase in the profitability. While that is wrong, it happens, and usually the period of one month or one year is shifted to the future year, and that's how it normally is achieved. So normally there is no matching of revenue expenses, or you may premature the revenue recognition means you have not incurred any cost yet. You have just done a contract and you are already recognizing the expenses, recognizing the revenue without recognizing the actual expenses even before the delivery. There may be a real sale, there may be a real contract, but the revenue is recognized earlier than the required one. You may have a long-term contract where all the payments you may be recognizing in one period instead of amortizing it, or you may have some big expense which you are actually amortizing over a period of time, when that clearly there is no benefit of that particular expense in the other periods. So that is called the improper matching of the expenses. So in and you are recognizing the expenses in one period. So technically, what would be the impact on the balance sheet? Let's try to understand with the help of an example here. So in this case, let's say we continue with our dummy balance sheet. Now you have recognized the sale for, so how will you do that? Let's say you have these transactions which are correct. Now you want to recognize some expenses to you want to improve the profitability from 10% to another percentage via proper transaction. So what you will do basically is, either you will say, okay, my cost of sale actually is not 3000, it's actually only 2000, right? So you may have purchased some expenses which you will show as advance paid. So instead of putting all the expenses into the expense, you reduce by 4000. So what you will do with the 4000, right? Because the balance sheet won't tell you. So what you will do is you will say advances paid to suppliers. So instead of saying that this 4000 are actually my this year expense, you will treat them as advance paid to the supplier for future expenses. So what will happen is your balance sheet will be tally, your profitability will improve to 30% without anything else. So you are just matching the not matching the revenue and expenses in the same period. So in this case, usually what will happen is your profitability will jump up, your advance sale is not impacted usually, because you're not adjusting the sales, you're mostly adjusting the expenses. So what will happen is you will have advance pay to suppliers, which may be happening in the previous year, may not be happening in the previous. So in this case, you have new accounts which are there, and when you are going to confirm them, the auditors are going to confirm them with the suppliers would not confirm it because there is no balance outstanding from them, right? It's not an advance. They will say the services have been done already. So the auditors may be able to catch it. So instead of putting into advance to supplier, you may put them as a amortization expense. So you instead of saying that instead of saying that as advance payable to supplier, you may put them into fixed assets. So can. and the next year you will put in you will charge, and you will charge them as a depreciation over a period of time. So there may be certain repair and maintenance expense huge in nature. So and but they not follow the valuation criteria, the capitalization criteria. So what you will do is you will put them as an expense or put them as a depreciation and amortize over a period of time, or you can say advance prepaid expenses. So in this case, when you are saying prepaid expenses, there is no, it's not a due from the supplier, it's not an advance to the supplier. So auditors will be not able to match it with verified from anybody except asking the management at what kind of prepaid expenses are they, when are they going to relate to, when are you going to charge them. So the management can will try definitely to put up the story behind the prepaid expenses, or may even charging into amortization by creating policies, because the accounting policies are internal. For example, you may be having a uniform policy. For example, you may have you can make an accounting policy for your company that all the repair maintenance expenses for, let's say, a big generator will charge in 12 months, because it helps to increase the life of the generator. Because these are sometimes technical aspects, so you may be the senior management may involve the engineers to get the sales or to get the advice from them, and create the trail of documents to prove that the expenses may are really related to the other periods instead of all the expenses related to the current period. So this may happen. So these are one example of how the mismatching will happen. The only way to detect this really is to compare the profitability with the previous periods, compare it with the other industry peers, what's happening in the industry. If there is a downturn, it will impact everybody. Right? Otherwise, it may not. Then otherwise, you may split the cost into the gross margin and net margin. So now you will understand more the importance of ratio analysis of gross margins and net margins, and also as an excess as sales expenses as a percentage to sales. So sometimes the expense may increase or may reduce. So the auditors are going to critically analyze all the expenses and other items to say, okay, are they justified, or is there anything which is hidden in the part? And then questioning really all the things which are not in the real benefit, real accounts. So there is a concept in accounting for nominal accounts and real accounts. So the balance, fixed assets, account receivable, cash is real account. Inventory is a real account, but prepaid expenses, amortization, they are not real accounts, right? They are fake accounts. They are nominal accounts. So the auditors will question the important the question the validity of these transactions, so that they can make sure that the balance sheet or the profit and loss is not misrepresented. So the red flags for these things are remain the same. There will be unusual profitability in certain periods. The cash flow from operations will be unjustified. So because you may have a profitability, but the cash is not really generated. So the cash flow is a pretty important part of the financial analysis. And then you will always see the complex transaction where there will be the real transaction is hidden between the substance or the form of how we are presenting them. Then there will be unusual increase in the gross margins in excess of the industry peers, and also there may be unusual growth in the accounts purchase, account receivable, or account payable days. So those ratios are important to monitor month over month, period over period, so that you can really see, is there any significant differences? If there are, why are those significant differences? So that you can understand really if the transaction is real or fake.